Now that the stock market is declining, dividend stocks are also becoming cheaper. In this video, 6 dividend stocks that could be interesting for you as a dividend investor. My name is Jorik Vermeulen. Welcome back to Happy Investors. And don't forget to subscribe if you want to get an update on our investment portfolio every month. I've been indicating for a few months now that the stock market could potentially crash. I myself am positioned with more cash, and as you can see, also a few more stocks in, for example, Europe. What I've actually been doing for about 6 months now, and at this moment it's paying off well, because indeed US stocks, especially good ones, are crashing. And yes, if you have more cash, you can certainly take advantage of it. Now we're talking about dividend stocks. For inspiration, here are 6 dividend stocks that might be interesting for you as a dividend investor. The first dividend stock is Toro with the ticker BTC. Toro, in short, offers all kinds of equipment for the garden, but also, for example, business to business with construction materials. And what's really interesting about Toro is not so much the dividend, but the combination of attractive valuation and long-term growth based on strong profitability. Because the Toro company is a kind of serial acquirer, and that's really interesting if they execute the strategy well. Morningstar gives a 4-star rating, which indicates that they have a small economic moat, and the QVS, according to Morningstar, is above the current price, meaning there's a very small margin of safety. From the list, the ratings indicate a price strength of 91, which means an upside potential of about 18%, and it's noteworthy that the lowest estimate is a price strength of 80, which is above the current price. Now that the stock market is declining a lot, this can certainly lead to bargains. Now, Toro might not even be the cheapest. I would say that there's something lacking in the margin of safety, but interesting enough for long-term investors because it's really about the long-term returns you can achieve. Looking at the valuation, we see on a long-term scale that the stock has declined and the current price to earnings / forward price to earnings is around 18. And if we zoom in a bit, it looks like it's approaching the fair value award, and it's below the normal multiple, which is the blue line. So the market usually pays a slightly higher multiple expressed in price to earnings. What does that mean? Well, that normal multiple from the past 5 years is around 24, but that seems a bit too high to me. So let's take the one from the past 20 years. A price to earnings multiple of 20. We see EPS estimates that average around 8%. That price to earnings multiple of 20, compared to the current price to earnings after a significant drop in price, could lead to an average return of about 14% per year. Per year. And this seems more attractive to me than the S&P 500 at the moment, but you also have to consider the possibility of lower multiples. Now, suppose that multiple is only 16 and this profit growth is realized, which is of course questionable, then the average return is only 5% per year. So we may have to be a little more patient here, and the market, mister. The market can provide us with value by pushing prices down further, especially if a panic sell-off occurs. The valuation seems just okay at the moment. The price earnings for next year is indeed set around 18 according to this model. The price of cash flow is on the lower side at 12, and they pay a dividend of around 2% per year. But you wouldn't want to buy this for the dividend, but for the capital gains, if you ask me. Still, the stock has dropped a lot over the past period to a market cap of about 7.8 billion. The total debt seems a bit on the high side, but that's of course due to their strategy, which is to acquire companies and brands, and they just add those to their portfolio so they can achieve higher returns, provided they execute the strategy well. But that's not at least according to the data model we have here, which shows their growth is limited in the coming years. However, what it's really about is the EPS growth and the free cash flow growth, and those are definitely showing positive figures. So here you really need to do your own research to see if everything checks out. The net income margin is around the 5-year average, so there's no significant spike up or down. But here we see the case for possibly further investigation into Toro. Why? The return on equity is consistently high. An open return on invested capital is consistently high. Of course, you want to invest in high-quality businesses for the long term that consistently achieve high profitability. So that's very interesting. When it comes to the dividend, it scores very high based on dividends. Next year, the dividend is estimated to be slightly higher than 2%, but look, the payout ratio is relatively low. For 5 years, I've seen such growth around 10%, which is quite high. and they have been paying out dividends for more than years in a row, but 21 years in a row of dividend growth. That's quite impressive. They have achieved dividend growth for 21 consecutive years and have been paying out dividends for 35 years in a row. So when you're talking about a dividend stock, you usually don't find many that are much better. That organ is part of it, and after the recent price drop, the price and also the valuation has become relatively more attractive. In the short term, analysts expect that the price will continue to decline nonetheless. Zexranken doesn't provide a solid foundation, but in their own graphs, they have price targets for 2025 and 2026, and those are higher than the current price. That also somewhat aligns with what we saw here at Refinitiv Ratings. Note that these are all analysts giving ratings, and you'll also need to calculate an intrinsic value yourself if you're a long-term investor. We've seen that the valuation is relatively okay, and the tower company has dropped significantly, even compared to 2023, by 60% and 33% compared to the last increase. It's a long game. As you can see, since 2020, the stock has actually been rising, but then dropped a lot again. So here it could be interesting because we have an attractive valuation and we might see a support level forming around the price of 72. If you zoom in a bit and set it to candles, you can definitely see that down here at the line on the price of 71. The price has been pushed up significantly again. But anyway, it's technical analysis. It's based on the current analysis, and that's the most important thing. That means the valuation, and that valuation seems to look quite good for the Toro company. It's not super cheap, perhaps due to some limited growth, but at least it's not very expensive, and still a better opportunity than, for example, very high-priced tech stocks that are currently dropping significantly. Deluxe Corporation is a stock with a high dividend that might be undervalued, but it could also be a value trap. The ticker is DLX, and Deluxe Corporation is a payment and data company. As a side note, I want to mention right away that I'm not super familiar with the company. I really noticed it while screening thousands of stocks, which we do every week. And this stock seems very cheap, but it could also be a value trap. The question is for you as an expert researcher, what is the answer? Let me know if you know the answer, of course. The analyst's price target is significantly higher than the current price, as you can see, with an upside potential of about 80%. But anyway, it's only about 3 analysts, which is actually a big advantage, because there's little coverage for this stock, and it's clearly fallen out of favor. Looking at Morningstar, they give a fair value estimate of $23. That also means a bit of a margin of safety with a 5-star rating. When we look at some statistics, and of course it's also about fundamental analysis regarding whether they will achieve profit growth in the long term, but statistics can at least provide us with some context, such as historical valuation based on EPS development. We see that for quite a long time. First of all, there have been quite a few peaks and valleys, but secondly, we also see that the valuation has actually always become relatively low. Right now, the price to earnings ratio is even around 5. You don't see that often in today's climate, and the price to earnings ratio has peaked at around 25, 26 at one point, but it's a relatively low valuation that the market is paying for this company. If we zoom in on the 7-year average, it also seems like it's undervalued. What does that look like? Well, if we use that normal multiple of 6, which is on the lower side, we see that after a significant price drop in the very short term, it seems to have upside potential. The analysts, in this case 4, give an EPS estimate of average growth of around 5% over the next 2 years. And in combination with a bit of multiple expansion, meaning that it becomes worth a bit more in price, that the market starts paying more, it could potentially yield a higher return of around 20% per year. And you can imagine that they might pay a higher multiple if it turns out to be better than expected. And it could even provide a much higher return, maybe even 40% on average per year. So this is definitely worth looking into further, and that's also what I'm going to do for myself. I noticed it during the screening because of the low price to earnings ratio. I believe it also comes back in the magic formula, if I remember correctly, and in some other screens that I use. And we see that the price to earnings ratio for next year in this data model is slightly higher, namely 10. However, we are basing this on these from FastRefs, and we also see that the price of sales, for example, is on the low side. The price of cash flow seems very low, and the dividend is very high. Sometimes, in some cases, a high dividend means that the stock is undervalued. but that's not always the case. What's the catch with this company? Well, first of all, the revenue growth isn't really good. And the second is high debt. The total debt is significantly high. It's double the market value, but well, the market value doesn't say much, but the total debt is really very high. That's why you need to pay close attention to how often this is the EBITDA or cash flow and whether they can afford it in a timely manner. This is actually about a dividend stock that could also be a value stock, but it might also be a value trap. If we look at the EBITDA growth for next year, it's actually estimated to be slightly negative. We see that the EPS growth is expected to be very high, so that's an interesting combination. Furthermore, there aren't many special details to mention, except that the company has been realizing a low profit margin on average for 5 years in a row. With a profit margin of only 2.5% at the moment, that's very low. However, the EBITDA margin is on the high side. Of course, this also has to do with paying off high debts. That's between the EBITDA versus the net income. Return on equity at the moment has slightly increased compared to the 5 year average. So, yeah, all in all, not superior. I wouldn't say this is really a high quality company. And as a dividend investor, you might actually want to focus on high quality companies. So, there might actually be an opportunity here. Well, the dividend yield at the moment is very high, 7%. The payout ratio is relatively low. They don't really show dividend growth, but they have been paying dividends for 25 years in a row. So the dividend history is actually very strong, but there's almost no dividend growth. But yeah, with a dividend of 7%, that's definitely on the high side. Now, what's going on with this stock is that it's almost at a very low point. The stock has dropped a lot. Compared to the all-time high in 2018, it has fallen by almost 80%. We see that the current price drop is now almost touching the level of 14, and indeed the price of 14 per share seems very low based on historical valuation. That goes all the way back to the model from 1988, and this price of 14 is even lower than the price in 2000, 2006, and 2009, but of course that's 20 years ago or longer. So you need to spend the whole day researching what's going on with the company and whether it still has any chance of success. Will it achieve profit growth in the long term? If the answer is yes, even if it's just a small profit growth of, say, 5% per year, then the stock is definitely undervalued. Plus, you also get a high dividend on top of that. I'm very curious about your findings on this stock. Also, let me know. Thank you. The stock of Tyson Foods is currently a strong buy based on factor analysis, and we highlighted Tyson Foods a few months ago, and since then it has still been on an upward spiral. The valuation has now increased and become a bit less interesting, but it is still an interesting dividend stock for the very long term. It's a food company with various brands, and if we look at analyst ratings, they currently give a price target that is about 7% higher than the current price. With a low target of -6% and a high target of +28%. That last one seems a bit too high to me. However, Morningstar also has a fair value estimate that is around that price level of 80, and that's why it has a 4-star rating compared to the current price. Looking at the historical valuation, we see that Tyson Food, after a long decline, seems to be back on the path to fair valuation, and if it achieves nice EPS growth, the stock could rise again. Moreover, it pays out dividends, and as a dividend investor, that's what you're looking for. The normal multiple over the past 5 years is quite low at 13.7, and even when we look at, for example, 10 years or even 20 years, it's a bit higher, around 15. A PE of 15 is normal, but let's be more cautious and stick to, say, 13.5. Well, we see below an EPS estimate from analysts quite a lot, so it may be correct. Only here in 2027, we see a high outlier, 25% EPS growth by only 5 analysts. So actually, that spike makes it seem more promising than it might actually be. Moreover, keep in mind, there are all sorts of statistical models that we show purely for inspiration about what the returns could be. Let's assume that all of this is correct. Then the upside potential would be around 7%, but given that spike, it could actually be a bit lower, but it could also be much higher. Why? Because it scores highly based on the factor analysis, and that's because the valuation is relatively attractive. The most important thing is, of course, to look at the PE ratio, because that also takes into account the price adjusted for the EPS growth, and that PE ratio is below 1, which is always favorable. So that would imply that there is a small margin of safety in this case. The price to cash flow is also relatively okay, and the dividend yield is 3%. It's important to keep an eye on the total debt, which is quite high. In the short term, I think there is no such thing with enough cash position concerns, but for the long term, yes, the point of attention remains high debts. But of course, you prefer to invest in companies without high debts. Tyson Foods isn't a great company either, but we're here for an analysis of dividend stocks, not for high quality businesses. By the way, we also provide an update on this every month, so if you want to follow that, make sure to subscribe to our channel. Looking at the growth, it might be attractively high for next year. You see a number of profit growth figures showing high percentages, and the EPS growth for the next 3 to 5 years could actually be very high. According to this model, the estimate is even made at 20%. And that's a bit higher than what we've seen here at Fastgraphs because there's a dip down here, or at least a lower point. The profitability is poor, which doesn't really indicate a strong competitive advantage, and that's also what Morningstar points out. But you often recognize a competitive advantage by consistently higher margins. Well, a net margin of 2% isn't good, but Tyson Foods is recovering in a positive way. Because the 5-year average of profit growth is around 3.6%, but otherwise you don't see any particularities. So, in my opinion, Tyson Foods isn't really a great long-term investment. The only thing you can be positive about is the dividend. The dividend is estimated to be around 3% for next year as well. The payout ratio is below 70%. That's healthy. 5-year growth isn't super high, but 4% is better than nothing. And the dividend growth has been 13 years in a row. Looking at the dividend history, they have paid out dividends for 35 consecutive years. So it is definitely a stable dividend company, or I should say a dividend stock, but it's not the best stock I can imagine. So I personally wouldn't invest in this. Moreover, that generally favors companies that consistently create higher return on investment and return on equity with a strong competitive advantage. So for me, the dividend isn't necessary because I'd rather have companies reinvest the money for long-term growth. While Zexshenken gives a buy signal based on EPS developments, their price target is slightly higher than the current price. So there's a small upside potential of about 10%, not very much at all. And we can see that the price is roughly around the EPS level. Ideally, you want it to be well below that. And then you can buy with a margin of safety. In this case, according to these estimates, that's not the case. Dyson Foods is also a relatively easy company to understand. There are many analysts who have already looked into it. So yes, most of the time, the consensus of the analysts is correct. Of course, the average, but there are always outliers both downwards and upwards. We've already highlighted Tyson Foods once before, since the buying moment, and since then it has risen significantly. Of course, the best time to buy is after a significant drop. In this case, that was 50%. Now, it has already risen a bit further, and that's despite the market declining, so that's a good performance. And yes, if you believe in the part of technical analysis and the return to an all-time high, that means 50% potential. Given the insights so far, I think it will take a while before Tyson Foods creates more attractive returns again. But in the meantime, at least there's a 3% dividend. The number is not extremely expensive. It could outperform, and we can see that reflected in the factor analysis. That indicates a strong buy. After a new price drop of about 35% and even 55% from the all-time high, Target Corporation might once again be an interesting dividend stock for long-term dividend investors. The ticker is TGT, and Target Corporation is quite a well-known company, relatively large as well. I might have expected them to have a small economic moat, but according to Morningstar, they have no economic moat. And the moat trend is also negative, which is never a good sign, of course. The rating is 3 stars from them. They really do provide a fair value estimate that is higher than the current price of 113. Let's take a look at the price estimates from analysts. They give an upside target of about 22%. That's quite a few analysts. And often Because there are so many analysts, the consensus is usually pretty accurate. Looking at the historical development based on fundamental EPS growth, we see that after a significant drop of about 55%, the stock might be undervalued, and it looks very interesting in terms of dividend stock. Of course, there's limited growth. The company has already grown a lot and may not have much growth left in sight. At least maybe management can surprise us. But that's why you should mainly buy when it could be undervalued. Well, that current price target of 12 is on the lower side. We see the EPS estimates from numerous analysts averaging around 6%. Sounds plausible if that's true. The normal multiple is currently not even at 17 based on 5-year averages, but rather around 20. In years, it's a bit lower, 16. So let's take a lower multiple than usual. Then, given the current circumstances, plus the EPS growth, it could mean that Target Corporation achieves an average return of 18% per year. That's obviously a much better potential outlook than the S&P 500, which is still a bit on the expensive side despite this significant drop. But if we have a slightly lower multiple, for example 14.8, then, of course, the average return is also lower. And an even lower multiple, for example 11, also results in a lower return. Based on factor analysis, it's currently a hold, but the valuation looks relatively attractive for next year. Unless the limited revenue growth is expected, the price to earnings is also projected to be 12.5. The price to cash flow is relatively low. The dividend has now increased by 4%. The growth is limited. Looking at the profit, yeah, it's not really great. Of course, they're a low-cost provider too. But what's striking is that they achieve a higher return on equity, not only contemporary, but also the 5-year average. That's even higher. The return on capital is also above 10%, but even 13% based on the 5-year average. So you wouldn't expect that at first glance given the company's earning model. But still, that's a positive signal. But we're here for an analysis, also for a dividend, and in that perspective, it's very interesting. The dividend yield is estimated at 4% for next year, and your ratio is healthy. The 5-year growth rate is 11%, and they have been paying a consistent dividend for many years with 56 years of consecutive dividend growth. You don't see that very often, so very interesting, a very strong dividend history of the company. Zacks rank indicates that it's a hold according to them. They also indicate that the value is okay, but it leaned more towards a buy because the price target from Zacks rank for the next 6 to 12 months is a bit higher than the current price target. So those are all good developments, and what you want to see is that the current price is below the EPS line, and that is indeed the case here. What's even more interesting is that we see a significant cooling drop compared to all-time high, down 55%. So yeah, what's interesting is that when you combine it, we know it's already a relatively favorable valuation, not super expensive, not extremely cheap either, but at least not expensive. And we see a relatively high return on equity, for example, over the past 5 years. When is the best entry point? You only know that in hindsight, of course, but what's important is that if the fundamental analysis seems okay, you still need to look at the management team and also at the future profit growth developments. What we know for sure is that the stock isn't super expensive, and we might see a support level around the price point of 107. That's kind of how this line is here. So that means the stock could drop a little further. If it ever drops to around 103, 100 per share, then it could be a very interesting stock to buy. Because what would that mean? Just a small uptick. After, for example, this latest price development in 2024 would mean that the stock rises by 62%. So that's quite a lot. I think you could do worse, but don't forget this is purely a piece of technical analysis, and what really matters is the fundamental development for the long term. In any case, it appears that Target Corporation is currently out of the picture in the market, and the market is very good at providing opportunities. In the short term, I think this stock is one of them.